This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Well, at the end of the previous lecture on corporation tax, we got introduced to that pro forma corporation tax computation, which again you'll see in front of you now. Now, what we know is that the main source, if not the only source in many companies' cases, of income that they have of profit chargeable to corporation tax will be the trading income. So it's probable that an awful lot of the work that you might have to do on any 15-mark corporate tax computation question set in section C of your paper might be the adjustment of profits and the capital allowances computations. And so most of our time will be given over to looking at how does that now change as compared to what you looked at on the unincorporated trader in chapter 4 and chapter 5, which again, as I said before, I hope you've revised through prior to this particular lecture. If we just look down to the next couple of sections here, section 3 and section 4, the basic issues that we've not seen before but are UT relevant so far as companies are concerned and are basically just normal issues in terms of preparation of the trading income calculation. What the company might be doing is to pay a royalty in relation maybe to a patent that it has the use of. Now, relief for those patent royalties payable will be given in line with the accounting treatment, i.e. we work on an accruals basis. So royalties payable will be allowed as a deduction when calculating the adjusted trading profit. So if we see in computing the statement of profit or loss, accounting profit figure, that such royalties payable have been deducted, then that's fine. There is no adjustment of profit. If they gave you an accounting profit before deducting the royalty payable, then you would deduct the royalty payable in deriving your tax adjusted trading profit. So the royalty payable is a normal allowable trading expense and it will be deductible in deriving the tax adjusted trading profit. Royalties receivable. What are we going to do with those? It's a separate source of income. But what we will do, and certainly will do at this level in terms of F6, the taxation of royalties receivable, again following the accounting treatment. So we look at royalties receivable in the same way as a moment ago we looked at royalties payable. We work on the accruals basis. Royalties receivable will be included within the adjusted trading profit. Again, no adjustment being required if we've already credited the royalties receivable in deriving the accounting profit, which you would expect to have happened. So although we might look upon it as a separate source of income, again it would be construed that the patent that we own from which the royalty arises is held as a trading asset. Therefore the income from it, the royalties receivable, are treated as trading income. So we didn't see that, though it's not impossible to have it in terms of an unincorporated trade. But again, the royalties, either payable or receivable, will go through in computing your trading income assessment. Now that we broached the subject of the tax adjusted trading profit, we need to look here in section 5.2 at how the corporate tax version of adjustment of profits may differ to that we dealt with back in chapter 4 when dealing with unincorporated businesses. And the beauty here is that in most terms it's actually easier, because in adjustment of profits for the unincorporated trader we saw private use in relation to expenses. There is no private use when it comes to corporate tax. Corporate tax, no private use. Private use, either here in adjustment of profits or a moment in capital allowances, does not exist in terms of corporate tax. Now they will try and, again, hesitate to use the word trick there. But again, as we've said before, they give you enough rope by which to hang yourself in the exam question by talking about maybe a company car provided to a director. A director might be the owner of the business, owner of the company, but to a director of the company who uses it privately. Makes no difference. It makes no difference in terms of adjustment of profits. It makes no difference in terms of capital allowances, because a managing director or anybody else is an employee. And as you learnt in chapter 4 and chapter 5, There are no private use adjustments when dealing with employees. There was only private use when dealing with the proprietor of an unincorporated trade. So don't be taken in. No private use adjustments in either adjustment of profit or capital allowances when dealing with corporation tax. Also, of course, there are no drawings here, either cash or goods, not relevant for companies. Any distributions are out of post-tax profits, i.e. dividends. They are not, of course, allowable expenses. So you won't see drawings. There won't be family salaries there. Either someone is an employee or they're not an employee. There'll be no family salary adjustments in terms of your adjustment of profits. No private use issues. Having got rid of those first three, which are issues pertaining to income tax but not corporate tax, we then see another new point that is unique to corporate tax, and that is legal fees. Well, we've seen those before, but regarding the issue of share capital. There's only companies, of course, that will issue share capital. These will only be an expense for companies, but they are of a capital nature. And what we know is that your basic rule of adjustment of profits in determining what expenses will be allowable, we will allow a revenue expense, we will not allow a capital expense. So this expense is disallowed, it's added back there in the adjustment of trading profit. So if you've got legal fees in connection with the issue of share capital, disallow. Contrast that, however, with if the company has sustained legal expenses or any other fees, costs attached to the issue of loan capital. The raising of loan capital, debt there rather than equity, then any such financial expenses in the raising of loan finance, those are allowable. They will be allowable for tax relief. But where we get that tax relief will be something of interest to us. And we'll see that in a few minutes' time. So let me come back to that in a few minutes' time. Also on legal fees, with regard to registering patents and trademarks, we spoke about royalties a moment ago, then legal fees to do with that are specifically allowed. Interest payable. Interest payable on a non-trading loan. Now, I mentioned a moment ago about the legal expenses in connection with the raising of loan finance. And whereas on the raising of equity capital it was a straight disallowance, there was another issue to look at when we have the raising of loan finance there so far as the company is concerned. And the issue is, what was the purpose of the loan? Now, if we've got a trading loan, then interest payable on trading loans, expenses incurred, like legal expenses, in raising that loan for a trading purpose, will be allowable deductions against trading income. They will be allowable. So the key issue when you incur expenses to deal with loans, whether it's legal fees or other costs, and when it's the interest payable on those loans, how and where do we get tax relief? If the loan is a trading loan, we'll talk more of those, as I say, in a moment's time. If it's a trading loan, then it's a trading expense. If, however, it's a non-trading loan, then there is an issue. So, interest payable on non-trading loans are added back, so they're not allowable against trading income. But the expense is still going to achieve tax relief because it's deducted against interest income. So we get a very strange scenario here, that if we have borrowed for a non-trading purpose, you might be wondering, well, what's a non-trading purpose? I'll come back to that in a moment. But if we have what we define to be a non-trading loan, then expenses incurred in raising that loan finance and interest payable on that non-trading loan are disallowed in the adjustment of profits. They are added back. However, where they will be deducted is deducted against interest income. So although they will not serve to reduce trading income, they will serve to reduce the interest income that you have on your corporate tax computation. Also, interest payable to HMRC treated as non-trading, so is also tax relievable against interest income, but it's not going to be a tax deduction against trading income. So if we've got interest that is either on a non-trading loan, or we have not paid our corporation tax on time and we have to pay interest to HMRC on the late paid tax, then it is disallowed in the adjustment of trading income, but instead will be treated as a non-trading deduction here, so it will also be set against the interest income. Again, more of that when we come to the interest income section of our computation in a moment's time there. What we also have, this final point, if we have interest receivable from HMRC, it is to be treated as interest income. Now you might be thinking, why would HMRC be paying us interest? Well, it's possible that we've overpaid our tax. We made an estimated corporate tax payment, and as it turns out, we overpaid. The estimate was bigger than the actual tax liability, in which case, on the overpayment, there will be interest that will be payable to us. You may guess, not a particularly large figure of interest will be payable to us, and that will be treated as income. So unlike the situation in income tax, where there was no deduction for interest payable on underpaid tax, and there was no taxability of interest received on overpaid tax, these figures do go through the corporate tax computation, where within the interest income section of that corporate tax computation. So, issues to watch out for, therefore, in terms of determining the tax adjusted trading profit. No private use adjustments. Watch out for legal fees. If they are as regards the issue of share capital, disallowed, add them back in the adjustment of profit, and no tax relief will be available at any point within the corporate tax computation there. It will be disallowed. If you've got legal fees in connection with the raising of loan finance, then tax relief will be available. The only question is, where will the tax relief be available? If it's a trading loan, then against trading income. If it is a non-trading loan, then we disallow in the adjustment of trading profits, we add it back and deduct it instead against interest income. And that rule is also applied to interest payable on non-trading loans. Disallowed in the adjustment of profit, it is added back in the adjustment of trading profit, but instead it is deducted against the interest income. So we do get tax relief, it is just a question of where. And if we've either over or underpaid tax, and we have therefore either interest payable to HMRC or interest payable to us from HMRC, then that too will go through the interest income assessment. So far as capital allowances are concerned, same basic rules in terms of the allowances available, be it AIA, be it WDA, be it FYA, but the computation is made easier because, as we have said, there are no private use assets. So the private use adjustments that routinely get tested when dealing with an unincorporated trader don't exist. Again, don't please be fooled, be tempted by the examiner where they tell you about a company car used by the managing director and it has private use of X% there. Irrelevant. The managing director, like everybody else employed within the company, is an employee. We do not make adjustments for private use by employees, only by proprietors, only when dealing with income tax, only for the unincorporated trade. Do not make that mistake. Only point to remember in terms of the allowances, I say it's your routine AIA, WDA and FYA without any adjustment for private use, is that there's only one AIA that is available within a group of companies, those related 51% group companies. You will have a choice if you have a group as to where you get to apply that, but there is just one AIA available, one lot of £500,000, you will recall. In terms of basis periods, you remember Chapter 4 in income tax was adjustment of profits, Chapter 5 was capital allowances, Chapter 6 was relating the accounting periods then to an income tax year of assessment. Not a problem here. Remember that we prepare corporate tax computations for chargeable accounting periods. So the period for which we've just adjusted the profit and computed and deducted capital allowances and established any other income, non-trading income and gains, that is the period for which we prepare the corporate tax comp. We do not prepare corporate tax comps for financial years. Remember our definition from 1st of April to following 31st of March. This is a tax definition of a financial year. Look back at the previous page of notes and remind yourself of that if you need to. But we prepare our corporate tax comps for chargeable accounting periods. Therefore, we already have the figure. We know when then we will pay our tax by reference to that accounting period. So life is a whole lot easier in dealing with corporate tax. Easier for adjustment of profits, easier for capital allowances, and easier in terms of how and when do we pay the tax, because we prepared the corporate tax comp for the chargeable accounting period, and it's for that period that the tax will then be payable. Now that sorted out your tax adjusted trading profit there. Moving on down, other sources of income. Property income to begin with. Now mostly when dealing with property income it's what we saw back in Chapter 3, but with some notable exceptions. Again, the property income is calculated on an accruals basis. Rental income accrued less allowable expenses incurred. But of course, for what period have we just said we prepare the corporate tax computation? It's for the chargeable accounting period. We've also then got another important issue. Interest payable on a loan taken out to buy a rental property. A few minutes ago we talked about non-trading loans. I said I'll explain to you, give you examples about what non-trading loans would be. Now here is your primary example of a non-trading loan. It might seem odd to begin with. The company would take out a loan that is not for a trading purpose. Now a trading purpose would be, well, hopefully we'd understand fairly obvious ones. Why would the company borrow to do with its trade? It borrowed to buy a factory, a warehouse, an office building used in its trade. It borrowed to buy plant and machinery used in the trade. It borrowed to increase its working capital. All of these are trading loans. But what we might have done is to borrow to buy a property, not in fact to use within the trade, but now to rent out. Now, if we were dealing with income tax and looking at property income, then any interest payable on the loan taken out to buy such a rental property would be an expense to set against the rental income. Not so in corporate tax. Instead, in corporate tax, any interest payable on non-trading loans, of which this is the primary example, a loan taken out to buy a rental property, is deductible against interest income, not property income. It goes against interest income. Now again, that will look like an odd rule, and because of it, it is often a rule that is tested by the examiner. So interest payable on a non-trading loan, the main example, one taken out to purchase a rental property, clearly that is non-trading, therefore it is not deductible against trading income, and if debited on the statement of profit or loss, you'd have added it back in your adjustment of profit exercise. But where do we get the tax relief? Not in fact against the property income to which it relates, but in fact against interest income. It is deducted, I repeat, against interest income, not property income. The only other example of a non-trading loan that you might see where the interest payable achieves relief again against interest income would be if a parent company, or indeed maybe any company, had borrowed to buy shares. If you'd borrowed to buy shares in another company, it's usually in a group situation, it could be in any circumstance. If you borrowed to buy shares, that is a non-trading loan. The company will still get tax relief on that interest payable, but against interest income, not against trading income. There won't, of course, be here in point C of section 6, there is no rent a room relief. The company can't be renting out a room in its own private residence there. That does not apply. If a company makes a property loss on its properties, again what you'll do is to do an overall total working for all its properties, working out the overall rental income, the overall allowable expenses. And if overall on its properties it makes a net property loss, then that will be offset against the total profits. Look back at your pro forma, and where do total profits come in? That was your trading income plus your other income plus your gains. Importantly, total profits was before deduction of any qualifying charitable donations. So any net property loss of the period will be set off against the total profits of the current period, that's the chargeable accounting period, and it's not likely that it would be, but if that loss was bigger than those total profits, then any excess not used this period is carried forward against total profits, again before qualifying charitable donations of any future accounting periods there. Okay, again, just take a moment to have a little recap through that, and then we'll move on to look at property income. Did I say property income? I meant, of course, here, as you can see, interest income. Okay, our interest, therefore, again, we work on an accruals basis. So all interest receivable is assessed as interest income on an accruals basis. The interest accrued, the interest receivable. Companies will receive all their interest gross, so there'll be no grossing up at 100 over 80 in relation to stuff like bank deposit or building society interest, though companies only like to have bank deposit interest. No grossing up. Don't be tempted, therefore, when you see bank deposit interest receivable for the period £8,000. You think, oh, I don't even need a calculator. I can gross that up by 100 over 80 very easily in my head. Don't do it. That is already a gross figure. No grossing to be done. Interest income is received gross by companies. But in the interest income section, not only do we include interest income receivable, but we also take account, as we were just talking about, interest payable is deducted against. Right, interest payable deducted against tax adjusted trading profit if it was a trading loan, a loan taken out for trading purposes, as we said a few minutes ago, to acquire, for example, a property for use within the trade, plant and machinery to use within the trade, or increase working capital. But if the loan is used for non-trading purposes, like the rental property, like buying shares, then it is deductible against interest income. It is relievable, remember, on a payable, on an accruals basis. It's relievable on an accruals basis. Interest payable. And as we've just said, main examples, acquiring a rental property or to acquire shares there. So interest income, dare I use the pun, is rather more interesting than you might think, because not only do we have interest income receivable, but it will be reduced by interest payable on non-trading loans. Now, once we have established the amount of total profit, that will be your trading income, your property income, interest income. It will also be chargeable gains, more of that later. But you would then have total profits. And from those total profits, you would then be deducting qualifying charitable donations. So far as companies are concerned, you'll be told about the qualifying charitable donations that were paid during the period. So companies will make their qualifying charitable donations will make such payments under the qualifying charitable donation system. The payment is gross. There's no question of paying net here. They are gross payments and deductible on a paid basis. So whereas mostly in terms of expenses we use an accruals basis in corporate tax, not when it comes to donations we don't. If you want tax relief for the charitable donation made, then you must have paid it. Thus, in the adjustment of the trading profit, that first exercise to do in terms of the preparation of the corporate tax comp, any such payments that have been debited in your statement of profit or loss, they are not trading expenses, so they should be added back and instead then separately included as a deduction on the corporate tax computation, the face of the corporate tax comp itself, as these things itemized as qualifying charitable donations there. So add back in the adjustment of the trading profit and deduct them instead as qualifying charitable donations. Where are they deducted? They're deducted from total profits there in deriving taxable total profit. Deducted from total profit in deriving taxable total profit. Dividends, well, we know dividend income is exempt from corporate tax. Doesn't matter who it's come in from, whether it's UK overseas, whether or not it's a related 51% group company or not, it is exempt. That therefore is to be excluded. It's never included in TTP. So for that purpose now, we've got example 1 to allow us to put together our computation of taxable total profits. It's basically here just a listing exercise, putting the items into the relevant slot where applicable upon the computation. So I'd like you just for a moment to pause here if you would, look back at your pro forma computation and then proceed to put your calculation of TTP together. So I want you to have a go at this, looking at the items on the computation. Look back to that pro forma, please, and then have a go at this. I will then take you through this in just a few minutes' time once you have made your attempt. Okay, well that should have been a quick and easy exercise for you to perform, I hope. We have been given our starting point of the tax adjusted trading profit. That would go straight on to your pro forma computation there. Underneath, of course, a heading properly set up. For whom are we preparing the computation? It's Westmoreland Limited. For when are we preparing it? This is the corporate tax computation for the chargeable accounting period for the year ending 31st of March 2016. Tax adjusted trading profit, 1,456,500. What we then also include, as well as trading income, property income. There is our property income, pick up the 25,000 included. We've then got interest receivable. So we then got interest receivable at 10,000. Watch out for that one. If there had been interest payable on non-trading loans, that would have reduced that £10,000. When it comes to chargeable gains, we've not yet seen, of course, how to calculate these gains. That's coming up in a short while. But we would take our gains less the losses to get the net gains of the year. And obviously here, that's net gains to include on your corporate tax computation of £35,000. Dividends from UK companies or from any other companies, no, that is exempt income, and that therefore is not to be included on the face of the corporate tax computation. So you could now get a subtotal of your trading profit, your property and interest income, and your net gains, and label that, of course, as that would be total profits. Away from total profits, we then deduct that one, the qualifying charitable donations there. Take it away, and you've then got your bottom line, TTP. Taxable total profits. Here, that's for the year ended 31st of March 16. That, of course, will be financial year 2015, but it makes no difference because companies now all pay their tax at a rate of 20%. So the corporation tax liability, I know it didn't ask you to calculate it here, would be your TTP times 20%. The fact that that taxable total profit, of course, may here, I think if you've worked it through and checked the answer, you'll have seen it will have come to 1.5 million. Now that, of course, will be relevant in the context of when the company then has to pay its tax and whether or not the quarterly instalment payment system will be operable. But as we said, more of that in chapter 23 there. But yes, having got the TTP, nowadays ever so easy in terms of calculating the tax, a single universal tax rate for companies of 20%. Take your 20%, that is your corporate tax liability. Now, when you look at past exam questions from whichever exam or revision kit you're using, from whichever approved provider that you purchase that kit, again, make sure it's a Finance Act 2015 kit. If you look at past exam questions, I'm sure they'll have been adapted in terms of the new question you see. But back in the old days, calculating the tax was a much more interesting calculation, because you may have had an accounting period spanning 2 financial years where different tax rates changed, and you may have been using other than just one tax rate. The company back then could have been small or marginal as well as large, and different tax rates applied. So there was a lot more marks available for calculating the tax. There's going to be just one mark available here, I would guess, and that's just because it's one single rate, 20% there. So it's a lot easier. So questions may look rather much easier now than they were when they were set. So just bear that in mind when you do some of the past examination questions. Okay, so we now know for what periods a UK resident company will prepare a corporate tax computation. It is for a chargeable accounting period. We know how to put together that corporate tax computation and what is included thereon. From our adjustment of profit and capital allowance computations, we get a tax-adjusted trading profit. We include any property income on an accruals basis. We include any interest income on an accruals basis. But interestingly, as we keep saying, from any interest income receivable, we would deduct interest payable on any and all non-trading loans there, as well as property and interest income, any capital gains. How we calculate those gains and losses, more of that later, but the net gains are then to be included. Companies pay corporation tax on their chargeable gains. They do not pay CGT. Having got the gains, we get total profits, take out the donations, the qualifying charitable donations, and that therefore will give us the taxable total profit. Now, we prepared the corporate tax comp, as we said, for the chargeable accounting period. What is it? Well, it, we said, was normally the same as the company's period of account. But there was one exception to that, and that is when the company prepared its accounts for a period of more than 12 months, when we had what we referred to as a long period of account. And if we have such a long period of account, then from it we will have to prepare not one but 2 corporate tax computations. In essence, very simple, we will prepare 2 computations, the first of 12 months, the second the balance of months from that long period of account. So as we referenced in at an earlier point, maybe in the previous lecture, if we had a 15-month period of account, we would prepare 2 corporate tax comps, the first of 12 months and the second for 3 months there, and in that order, 12 months and then 3 months. Now that means that from one statement of profit or loss, one period of account, we have to prepare 2 computations. How we do that and the rules that we use, well, that follows in the next chapter, and we'll go on to that in just a moment's time. But that will be included there. Move to now the next chapter on the long period of account.